Welcome to The Explainer. All right, today we are going after one of the most tempting numbers in all of crypto. You see it everywhere, it promises these huge returns, but what's really going on behind the scenes? What's it actually costing you? Let's find out.
So you're scrolling through a DeFi platform, and then, bam, there it is, 247% APY. Your eyes just pop. I mean, it's almost impossible not to look at that number and immediately think, wow, if I just put my money in there, I'm going to get rich. But you got to hold on a second.
The short answer? No. It is nowhere near that simple. In fact, that number can be super misleading, even dangerous, if you don't understand what it's hiding. So let's pull back the curtain, shall we? Okay, first things first, we got to have a little mental shift here. We have to stop thinking of providing liquidity, LPing, as just earning simple income. This is not a savings account. What you're actually doing is taking on a specific financial position, and every single position comes with its own unique set of risks. And here's the crucial point, right? That giant APY number, it's only telling you about one part of the story, the fees you might earn. It completely and conveniently ignores the risks you're taking on and the very real costs you're paying just to be in that position in the first place.
So what is this big secret that the APY number is hiding? Well, it's a really powerful and honestly often misunderstood risk called impermanent loss.
Just look at the definition right here. In plain English, it's the performance gap. It's the difference between what your money did in the liquidity pool versus what it would have done if you had just left it alone and held the two assets separately. Think of it as the price you pay for a chance to earn those fees.
And this right here perfectly illustrates the core trade-off. See, the automated market maker is always rebalancing for you behind the scenes. It's automatically selling the asset that's going up in price to buy more of the asset that's going down, all to keep that 50-50 value balance. You end up with less of the winner and more of the loser.
And this comparison, it is absolutely critical. To know if you're actually making money, you can't just compare your LP value back to zero. You have to compare it to what you would have made by doing nothing, by just holding the tokens. That gap, that is your impermanent loss.
Okay, that's the theory, but what does this actually look like in practice? Let's put some real concrete numbers to this, because this is where the risk becomes, well, undeniable. So check this out. If one of your assets just doubles in price compared to the other, a 2x move, your LP position is already worth 5.7% less than if you had just held. Think about that for a second. Your fees have to climb over a 5.7% wall just to break even with someone who did absolutely nothing.
And notice how this isn't a straight line. It's not linear. The loss actually accelerates. At a 3x price divergence, you're now in a 13.4% hole compared to just holding. And at a 5x move, which, let's be real, is not that unusual in crypto, you are now looking at a staggering 25.5% loss. Your fees are now in a massive hole and have to work incredibly hard just to get you back to where you would have been by just holding.
So, this brings us to what I think is the most important takeaway of this entire explainer. Seriously, if you remember only one thing, make it this. This is the real formula for calculating your profit. Forget that headline APY. Just ignore it. This is the equation you have to use every single time. Your actual real profit is the fees you collect, minus the impermanent loss you take on from price changes, minus any other costs. And yeah, don't sleep on that last part of the equation, costs. These are very real expenses that will absolutely chip away at your returns. We're talking gas fees to get in and out of the pool, any management fees for more complex strategies, and of course, the risks involved if you're bridging assets between chains. They all add up.
Okay, so now that we have our real formula, let's look at how that big risk factor, the impermanent loss part, changes dramatically depending on what kind of pool you decide to jump into, because they are not all created equal.
This right here is why a 20% APY on a stablecoin to stablecoin pool is a completely different beast from a 20% APY on a volatile, totally unrelated token pair. In the stable pool, your divergence risk is super low, so that 20% is much closer to real profit. But that volatile pool, it could see a 5x price move that wipes out your entire yield and then some.
And then you've got these newer platforms with concentrated liquidity. Now, this can totally supercharge your fee earnings by focusing your capital in a really tight price range. But here's the trade-off. If the price moves outside your little range, your impermanent loss can be way more severe, and you might just stop earning fees altogether. It's a high-risk, high-reward game that demands you pay close attention.
So, how do you actually put all of this into practice and start making smarter decisions? Well, we've boiled down all the key lessons into one simple checklist for you to use.
Before you even think about depositing a single dollar, just calmly run through this checklist. Number 1, pair type. What's the risk here? Is it stable, correlated, or a total roller coaster? 2, fee source. Are these fees from real sustainable trading or just temporary incentives that are going to dry up? 3, divergence risk. Realistically, how much could these prices move? Be honest with yourself. 4, costs. Add it all up. Gas, management, bridging. What's your total overhead? And finally, number 5, have an exit plan. Know when you're going to get out before you ever get in.
And really, this is the bottom line. If you can't put a number, or at least a realistic ballpark, to your potential divergence risk and your total costs, then you aren't making an investment decision. You're just closing your eyes and hoping for the best. And let me tell you, hope is not a strategy.
So, to wrap this all up, let's bring it back home to our core equation. Let's say it one more time. Your real profit will always be the fees you earn minus the impermanent loss you suffer minus your costs. That's it. Think of it this way. The fees are literally your payment for taking on the very real risk that prices will diverge. The only question you have to ask is, are you being paid enough for taking on that risk?
And of course, just a quick reminder, this explainer is purely for educational purposes. It is not financial advice. All investments in this space carry a pretty significant risk of loss, so please always do your own research. Thanks so much for watching.